Well, good afternoon, investors. Welcome back. I see a lot of familiar names and faces. I know that all of you are out there wondering about your Halloween candy. You do have a few days left before you have to stock up for that. But here we are in October in our hunt for the best small companies. My name is Mark Robertson. I am joined here by Ken Zipline Kavula. You're right there. So good afternoon, Ken.
Good afternoon, Mark. Back and ready to go again. Feeling refreshed. The colors were starting to turn, but we're not in full color season up north yet. So if you're anywhere near the northern climes, whether it be Wisconsin or Michigan or even Ohio and Pennsylvania, now's a wonderful, wonderful time to go out driving on a particular day if you got some sunshine.
And you did keep your feet on the ground and didn't do that zip line thing, is what I'm hearing.
No zip line, no swinging bridges, no glass bridges. Those were rules that were set to me by my spouse before we even left to go up north
Oh,
this
man.
week.
There you go. All right, so we are joined on the cover slide. It's the only way Ken and I will ever be on the same slide with Warren Buffett is if he's there in cartoon form. Well, I would say I would never say
you make
never,
the slide, right?
but Warren is helping us to celebrate another milestone moment with Tin Cup. We'll actually cover that, and then we'll dig into the best small companies. By the way, we're also joined by Kim Butcher. Good afternoon, Kim. And Kim has muted herself again.
Yeah, sure. Her audio is
And
disconnected.
either that or she is disconnected. And that other voice you hear is Houston's own Matt Spielman. Good afternoon, Matt.
Good afternoon. Here, Kim's back.
Hey, Kim.
Hey, I'm here now.
Just wanted to pass on that I received a number of kudos and thank yous over your coverage of Dataroma last week.
That's what we're here for, to share our knowledge.
Yep, share ideas. What's on your mind?
I've been following the correspondence between Matt and Kim over the donuts in Houston and in Indiana and in Florida. So we'll have to get a segment on donuts to match the hot dog segment pretty quickly here, Mark. Okay?
Yeah, between that and Torchy's Tacos and the others that we're watching, including Bucky's, we're gonna.
Well, you can watch. It's privately owned, but any donut incursion into Houston has to overcome Shipley's, which reminds me the most of my hometown bakery, which is long gone, that I've ever had. In fact, it's when my mom's coming to visit next week, and I'm sure a visit to Shipley's will be on her list. So
there you go.
Donut incursions are a big deal. But this one happens to come from Evansville, so that was why
that's the connection. Yep. Good stuff. All right, and then of course the $5 million bills there are in honor of Tin Cup. So let's go ahead and get underway here. Just a quick moment to remind everybody that no investment recommendation is intended. This is entirely an educational demonstration. We're big on demonstration of the concepts and wonderful lessons we learned over the last 8 decades with the modern investment club movement, so that we're here to basically share those ideas and hope that they will in some way favorably influence your investing, your long-term investing successful experience. So please make your own decision about anything that you look at, whether it's company or tool or method. We are not the boss of you. Make your own decisions. If you would like copies of the slides, if you have follow-up questions or suggestions for topics, our 2 email addresses are there on the page. Anything else, Ken?
No, I was just looking up the name of a bakery that I went to on vacation, so I had one ready to go. So let's keep these slides moving here,
Isn't
Mark.
it Mr. Tom's or whatever up in Harbor Springs? Tom's?
No, it's a bakery from before World War II in the and it's called Potter's, and we go to that for breakfast quite often when we're in Traverse City, 2 or 3 times. In fact,
cool.
I brought home a whole box full of beautiful, beautiful baked goods from there. But they've been around since 1938, I think. Very, very excellent bakery.
Well, I imagine you have some Cleveland bakeries also. We did not frequent one of those while we were there, but I'd be surprised if we didn't at some point in the future.
Let's. I'm trying to get back to our screen here. Keep
This is
going.
not the health food edition of Bull Sessions.
This is not when you stop on the Portillo's page. All right, there's the cloud again. I don't know how to read the cloud other than to say everything on the left there, which is an AI probably coming from ChatGPT, summarize the situation type thing, and it didn't summarize it very well for me. Some of you out there are much smarter than I am, and you can probably figure this stuff out. But what this is basically suggesting is that Portillo's stock price has dropped and that it may be um, not dropping so much in the near future. And I don't know. I think you get that from the RSI. I don't know how you get more from the Ishimoku than you do from the RSI, but or the money flow at the bottom. But
Someone
anyhow,
spilled the ketchup. That's what it looks like to me.
yeah, there's a lot of
Ketchup
ketchup on that slide, and everybody, and I mean everybody knows you don't put ketchup on a hot dog, so they don't go together very well. All right, moving on. Here's some of the stuff going on this week. Pepsi is among the update companies. Obviously, we're out there in the pumpkin patch. We are doing some field research on adult beverages when given the opportunity, and probably is time for an adult beverage tipped in the direction of Tin Cup, Ken. Um, Pretty good story. We did actually reach 5 million back in January, but that was not long lived. And we did actually close September above 5 million, so we'll take a closer look at that. All right, pressing on. Ken, we couldn't do this without you last week. We had to close down the third quarter, so that green bar is now etched in stone on the far right, and we'll begin the next quarterly bar next week. But this is just our weekly reminder that stock prices do fluctuate, so do return forecasts, and it's not unreasonable to expect a 10 or 11% return over the long term investing in a blend of medium, small, and large companies. What are your thoughts here, Ken?
I just think it's a graph that reminds us about that long-term average, Mark, and reminds us that we have a pretty good shot of matching or even beating that using the methods we've been talking about for the last lots of years that I've been involved in all of this stuff, and lots of years that you've been involved in all of this stuff. Those 8.8, 8.9, 8.7 numbers make me really happy when those three numbers cluster that tightly together. That says that we're probably getting a very true read on the future of the market for the next couple of, maybe the next 6 months, maybe the next 12 months, maybe even a longer trend.
Yep, longer term, I think a 9% return still makes a lot of sense. And those numbers are all basically in the 9% range that you see on the right there. Oh, excuse me. And the one thing that I would note for everybody is anytime that green bar on the far right peaks up above that red line, and this is an exponential thing that you can witness on CNBC, by the way. Anytime that green peaks up above, you start seeing all kinds of pundits and talking heads coming on talking about how certain they are that we have a coming correction. And it's actually the daily roster at CNBC now is full of those type of commentaries, and it just gets worse if that green bar hangs around up there for any period of time.
I've been telling people that I've been talking to in the last couple of months, Mark, that I'm still waiting for the 2023 recession that everybody predicted was going to happen. So I'm here. I am almost closing out 2025, and I haven't got to it yet. But I'm pretty sure it'll be here one of these days. But it was predicted way back in 2023, if you remember.
That's right, and it's still in the prediction mode. By the way, Matt shared that Peter Lynch was actually the guest of Josh Brown in a compound. It was just Josh Brown and Peter Lynch, and it's available out there on YouTube. We actually put it out on the manifest page. Really good interview. The thing that reminded me, Ken, was he talks about 33 of the last 13 recessions being predicted as part of his spiel, but it was pretty good. So thank you, Matt.
Yep, the CNBC headline they picked up on was Peter Lynch is not invested in AI.
I saw that. Yeah. Kind of
That's
like Buffett in technology 20 years ago. You
yeah,
finally
exactly.
get there. Good stuff. All right. Here's a quick look at our performance perspectives. And we are going to take a closer look at the Tin Cup demonstration portfolio, which does check in, beating the market by 5 percentage points. That's 500 basis points for those of you who speak that language. And pretty good run for Tin Cup here lately. We'll be diving in a little bit deeper to that. And the roundtable's behaving pretty well too. Anything north of the Wilshire 5000 is an achievement. And it's just a quick reminder. And then, of course, the 10 companies that are shown on here are the 10 most widely followed and probably most widely held companies by our audience. And pretty cool.
Mark, is there any reason why the Wilshire 5000 is using a different performance since date than most of the rest of the list?
Just Mark and his fat fingers.
Okay, all right. That's a suitable explanation. Okay.
I'm making a note that Ken wants that date to match up, and for some reason we stopped on 1214, and well, the one thing it does actually give us the opportunity to witness is look at how hot the market has been with just a few months there. The 14.7 right next door is just showing that it's been a pretty robust Wilshire 5000 over the last, call it 9 years, pumping that number up a little bit.
Okay.
All right, and then of course that rule of 5, I had it up there as a rule of 10. I just thought it makes sense to simplify it to speak our language. And as Kevin Gologly pointed out, David Babson suggested that we really aren't doing it right. We are, or we're not capturing the moment correctly when we talk about the rule of 5, because the one that we have consistently repeated over the last several decades really applies to income stocks. And for quality growth stocks, this distribution is what David Babson thought was probably a better characterization.
I know you and I have talked about this kind of in a mathematical viewpoint, Mark. It's kind of like taking the traditional bell curve and moving the peak of the bell curve a little bit to the right on the graph because we're trying to pick stocks that have a benefit to them to start with.
Absolutely. It's just that tiny advantage. That's that 55% advantage that we talk about. You don't have to be right all the time. By the way, Peter Lynch in that interview is explicit about that rule. He actually mentions Tillinghast. And he talks about being right 50 to 60% of the time in the middle of that interview. So that's kind of a neat moment also. All right, so we're going to take a look at the groundhog as we come down to our final 4 months of the groundhog also. And we're having a pretty good run. And yes, Ken, this number is different because it's the start of the current contest. So good stuff.
That I understand, right?
All right, and this one's kind of fun too. We just continue to reinforce that our community, people hanging together, sharing ideas, and pursuing opportunity, using some time-honored traditions. We are kind of ending up on the right here, and hope that continues. And as Ken pointed out beforehand, investing in the average rhino is, hold on for just a second. I thought. The average rhino is not doing very well compared to the average stock or average index. Okay, so let's go ahead and talk about groundhog. I am privileged to say and pleased to be on the list at number 40. So I'll sit back and smile. And Ken, what else do you see?
Well, I just want to shout out to motivated investors that are brand new to the contest this year. They were very disappointed when Mid-Michigan finally put its own contest to rest after 16 or 17 years. but we convinced them that this was an equally good contest to keep some interest going. So they joined, and they're up in 5th place right now, and they're quite excited about their results at the moment, Mark.
Yeah, they're the group leaders, taking over the pole position from our traditional champions, Bauer City and Broad Assets. So that's a pretty good show. Richard Corkins is from Michigan, continues to lead. In fact, he's pulled away a little bit. So, Richard, don't get carried away. We still want to make this a horse race, but doing pretty well. And friend of Phil Crocker's, got to mention her because she's had lukewarm results a couple of the years she's been in the contest. Nikki at number 7 is threatening the top of the leaderboard, and that's good to see.
I would give that a try at Petrika, Mark. Nikki, if you're with us today, tell us how close I came, okay?
I think that's a pretty good guess. So again, the average groundhog's doing pretty well, and 3 out of 4 of you or us are beating the market. That's phenomenal. And I think historically we run in the 50 to 60% range, so that's doing pretty well. And just a whole bunch of very familiar names on this list from top to bottom. By the way, there are 209 participants, I believe, just to give you some context for the level of achievement. Because I can remember coming in 20th when there were 24 participants, Ken, so it's a little different. All right, so this arrow is actually next to, we put in some celebrity or whatever you want to call them, rhino entries. In this case, this is a long-term call option. So it's in no danger of expiring during this groundhog challenge. But just a quick reminder of how leveraged and how volatile this type of investment can be. You can see that from Groundhog Day until what came to be Liberation Day just a couple months later, it was down 76.5% at that point in time. And it languished in or near last place, 208th, 209th for a long time, but it has been steadily climbing, and it's actually in the top 40 now. So again, just to make the point, it's a long-term option, which means that it's going to have magnified or amplified results. This one is in no danger of expiration during our contest because it expires out in 2027. But just to give everybody a feel for what type of a performance you can experience with these type of call options.
You mentioned Phil Crocker on the last slide, and his hand is in the air. I had my hand up list sorted in the reverse order that I should have had it, so I didn't catch it right when the slide was up. But Phil, if you want to unmute yourself, I've unmuted you, and you should be able to talk to us.
Oh, good afternoon, Phil.
In order to talk, Phil, you'd have to, he took his hand down, so maybe that was in it.
I'm here.
You are here. Go on, Phil. Yeah, go on.
With my half an eye, I have to find the buttons. Just a quick note, Nikki is kind of the glue that holds our club together. She's one of those engineer type gals that gets into digging into all of the details and whatever. But
Phil, pronounce her last name for us, would you?
Petrika.
Petrika. Okay, I was close, but not right on the ball. So Petrika, and I'll try to remember that in the future here because she's been with us for a number of years in this contest.
Yep. And
just one quick note, a couple of years ago, she did buy the 20 small stocks, and that was, I think, the first year it didn't go up.
It's the only time we've done that.
Nikki, stay out of the market for the small stocks this year, okay?
Kind of like Jim Gallagher, you can be up one day and down the next.
We had such a run going there. We put the screeching halt to it with the brakes by providing a way to invest in the 20 through an institutional fund. And oh well, the things you learn. And by the way, Phil's colleague Robin Ware is on the list here also. Good stuff in the water there in the north end of Florida. All right, enough on that. let's go ahead and talk Buttonwood for a second. Again, this is our demonstration portfolio with real money. We're just doing it to demonstrate what can be done. $100 is donated to this every month. You can see that we do have a little bit of cash to take care of. We will probably be investing that at next week's bull session. And it's actually been behaving a little bit better. We'll take a closer look at it. But Ken, where the growth is in that 12% range, quality is good, the par is pretty good, probably improving with some of the updates and a little bit of increased expectations from the analyst communities out there, including Value Line. But what do you see here? What are your thoughts?
Well, I want to put a couple of stocks on. I don't want to put them on the hot seat, but I want to put them on notice, I guess. I want to make sure that we do a very stringent audit on IES Holdings, which is showing a par right now of only 3.3, but showing sales growth, very, very decent sales growth at more than 14%. So I want to make sure that par is as low as it is, and then if it is, I want to continue to monitor it, because we have some guidelines for really great growing stocks that have very low pars, and we'd like to review that concept again if need be. The other one that I want to take a real on notice look at is Alphabet. The par has slipped now down to something that is below average, and it is about 10% of the portfolio, which is on the bigger side of our holdings. It's the second largest holding. It might be time not to sell the whole thing. It still has 11% growth. It's still a gargantuan company and everything, but it might be a time when we would get a little bit of cash from that account and put it into some of the juicier stocks that are sitting kind of near the bottom of the list at the moment, with the same kind of sales growth or better even, and pars that are significantly better. I'm specifically looking at Deckers, for example, Mark.
Mm-hmm. Yeah, and I think it's just prudent. I think the IES position is one that we can look at very carefully and honor the I don't want to call it a rule or a law or anything like that, but anytime you have a 14% grower, you want to be reluctant or slow to sell it. And sometimes this is just a matter of the analysts not catching up. This is a company that is benefiting from data center construction. And
well, and on top of that, Mark, we just bought it at a very opportune time too. We bought it, and it's really gone to town. It's kind of hard to trim a stock where you only own 0.65 shares. So, but that's just the problem with the small amount of cash that we're dealing with. This is not a nest egg portfolio. This is a demonstration portfolio. So. But I think there is some discussion to be had in our portfolio management, and it's the kind of discussion that I would urge you to have with yourself if you're just investing personally, or have with your club on a monthly basis. There's always some stocks that you can talk about, and whether or not you need to do a little tiny bit of jiggering. I would also advise you to really do serious thinking about the fact of understanding that discussing a sale does not mean making a sale.
Absolutely.
And you got to keep that in mind constantly as you're doing portfolio management.
Well, just as a case in point, we have discussed that we might trim or get rid of Gentex if it gets hot. I mean, if it gets, let's say that the RSI goes above 80, and the return forecast dips down to 5% or something like that. We have discussed the willingness to, at that point, take action on Gentex.
Well, and I think it's important to point out that Gentex was showing us par values quite a bit higher than 10.7 3 or 4 months ago. That par is moving in the wrong direction for that company, and the sales growth has not really changed dramatically for the company. So it's not hurting the portfolio at the moment. with the par almost at the average par of the portfolio, but it certainly is one that we still want to keep an eye on.
Yeah, and as we were talking before we got started a little bit, Green Brick is going to benefit from the changeover in data and some of the slightly more optimistic outlook from the analysts following the company. That growth rate is going to go up to probably 13% on the next update. And if you look over our community, you'll find that many of us would be comfortable anywhere in that 10 to 13% range for growth. That will benefit this number over here and benefit the entire portfolio. So
absolutely.
So we are seeing a little bit of constrained optimism coming into some of these companies, and that's a good thing.
And if you're new to our group and to what we're talking about with portfolio management, we're looking at that small chart in the bottom left of the slide, and we're focusing on the par number, but we're equally focused on that sales growth number, the third one down, because we really believe that over long-term investing, that the sales growth number will predict the par long-term. They will disassociate themselves many times short-term, but we're long-term investors, 3 to 5 to 7 to 10 to 20 years in some cases with different stocks. So we're very concerned about keeping that growth, and we'd love to see it maybe at 12.5 or 13 if we can push it up that high.
Yeah, I'll make a note to get our fund manifest as part of the slides for next week, just to underscore that successful funds are designed to succeed by virtue of their growth forecast. And
yeah,
we took a look at that again. All right, here's a quick look at basically the series of results. Our rate of return is actually up in the 10% range now. We like that. And some of that optimism or reduced pessimism is going to come in as we switch over and update a little bit. That portfolio par is up a little bit, and that, of course, has caused a little bit of a uptick in the long-term expectation for the fund. But all of these trends are in the right directions for the most part. All right. Anything else here, Ken?
Well, just to say that it's a really good thing if you can grow the balance of your portfolio, and you grow it by stock price appreciation, but you also grow it by capital contribution. And we do put capital into the portfolio once a month, invest regularly. And if you can grow the balance and at the same time keep your future value growing at an equal or even better rate, I think you're doing the job. You're making clear what it is you want to do, and then you're focused on trying to make that happen.
Yep. Good stuff. We might have to mute somebody.
Without your knowledge or consent to visit websites that contains network and identity.
You got that,
We
Ken?
got somebody having a real, they muted themselves, whoever it was. Thank you.
That was Kim.
Thank you.
Kim.
Okay.
That's probably one of those ocean liners backing up in the canal. All right, so let's go ahead and talk Tin Cup for a minute. Ken and I both went to, I don't care whether you call it a review or a musical or whatever, it was a great show that we went to. Neil Diamond, the music,
it was the Broadway musical that's been on Broadway for a few years. It's basically a biopic, if you will, of Neil Diamond, but it includes a lot of his music, and those of us in a certain generation grew up with that music, and it was certainly a rousing afternoon to listen to all that, and to be surrounded by more than 1,000 people, all of them equally enthralled with what was going on. So,
and they all sing "Sweet Caroline" along with.
Everybody sings, yeah.
Just like at the baseball game. So there you go. Worthy of celebration. Here is a look at the Tin Cup balance. This goes all the way back to 1994. We'll talk about that in a minute. But at and above and remaining above at the end of September, above 5 million. So
I
again,
think what's so nice about that date 1994, Mark, is that that's 30 years ago.
mhm.
And 30 years is a really good benchmark for an awful lot of people as far as their career length is. You know, a lot of folks in the education field, a lot of folks in the auto industry around where I live, they look at 30-year careers as fulfilling and maybe as an entire work life if they've planned correctly. So we're looking at 30 years of accumulation at the legal rates in a 401k or whatever your vehicle might happen to be going forward. And $5 million sounds really good for putting in a relatively small amount of money on a yearly basis.
Yeah, I wish I could say that I had actually done this personally, but you weren't here last week. I got into the details of it, Ken. But yeah, what it does, you know, if you have somebody that's in their 20s or 30s in your family and they're wrestling with the notion. In fact, this is also in the Peter Lynch interview with Josh Brown. One of his family members had access to a 401k with 100% matching, and he wasn't doing it. And Peter's like, well, that's a double to start with. You got to get in there, man. So yeah, if you've got a young person trying to come to grips with this, it's such an incredible difference maker in a future. And the numbers start getting so uh, large if you're successful and fortunate that obviously we all want the blue line, not the red line, and that's
Well, even if your company's only, and I'm putting air quotes around the word only, Mark, even if your company's only matching 25 or 50% of your contributions, it's still a really great boost to any kind of investing you can do on your own. You should take it. You got to take it.
By the way, I'd never thought about this. This contains zero matching.
Oh, absolutely.
So the way that this was laid out, zero matching. Maybe one of these days I'll ponder what that might have been. We also went back and took a look. There's an article that's out at Manifest Investing on the Tin Cup, and we thank Dan Hess for the inspiration going back 30 years, as Ken said. But it really does, you know, maximum amount into a 401k. We pretended because back in the earliest days of this, very few companies would allow you to invest in individual companies. And so we had to pretend that we could do that. That changed about 10 years later. Almost every company out there, even if they won't talk about it, sometimes you have to nudge them, will allow individual stock investing in a 401k. So again, going all the way back to 1994, here are the things which are being demonstrated here: investing regularly, your monthly contributions, remaining invested. It's basically been on 0% cash for the entire time until the last couple of months. And then here's the strategy behind it all, really. And if you don't know who Walter Schloss is, Google him or use the site search at Manifest Investing and spend some time just absorbing what Walter had to say, and his track record speaks for itself. So.
I first read this article a long time ago, Mark, and I've had the opportunity to read it, 2 or 3 times since. And the one sentence that resonated with me the very first time I read it was down in your 4th bullet point down there, where basically you told me that Fisher believed that most investors own too many stocks. And that certainly was a something that I did in the beginning as an investor, thinking that I was really being smart. And in fact, I wasn't being very smart in putting together a portfolio of 45 or 50 stocks. In fact, it was making me do more poorly rather than better.
Yeah, I think somebody once told me that when you have too many stocks, you have diversification.
Mm-hmm. Yeah, and there's books written on the subject of many mutual funds approaching index averages because they simply have to, by the virtue of the number of stocks that they own. So Buffett believed this, so did Phil Fisher, and we kind of ended up there. and we'll probably remain towards the low end of that 12 to 20 spectrum that we talk about so much. Again, we don't do a lot of selling. There have been multiple years go by without any selling. When the market gets, hot and the return forecast dipped down, we will do some prudent selling, but the average position is at 4.2 years, and now is checking in at about 16% annualized total return.
I think also, Mark, what's really good about this demonstration is that it's never had any always rules or never rules.
Mm-hmm.
The rules have been flexible enough so that when there were instances when you had to make an exception to something that you were usually doing, you did it without feeling guilty. And I think that's very, very important for investors to keep in mind, that creating rules that say always do this or never do this limits you in what you really should be thinking about when you're trying to manage a portfolio.
Here's the current portfolio that adds up to that $5 million. You can see that there are only 10 companies and fairly well distributed. And we'll take a closer look at this. We are in the middle of an update. That's why some of these numbers will be slightly different. But here's the worksheet that we use for any portfolio that we look at, called Dashboard Diagnostics. And we basically zoom in on, looking for to keep the return forecast high enough, the growth forecast high enough. All of these numbers are key as we take care of any particular portfolio. So we want the growth number to be high enough, and obviously the return forecast to be high enough. Quality tends to take care of itself. Ken's eye goes to this one because he just, he goes to the lowest score on any report card when it comes in front of him. But couple things here. You can see that the positions are all within the size recommendations, and again, that's not a always or never situation either. But if any one of these got to be above 20%, we probably would take action. You can see that Google, as Ken mentioned, for the other portfolio, has the lowest return forecast, but I also mentioned, as we did earlier, it's got double-digit growth, so you give it some latitude. And you can see that Taiwan's been hot. What's on your mind, Ken?
Well, nothing's on my mind except that when you're talking about Google, I even think that I would give it latitude if that sales growth dropped to as low as 9%. I mean, this is a gigantic company.
It sure is.
And to grow at 9%, I think growing at 11 is terribly difficult for some company this size to do. And growing at 9, I would still take even 9. I wouldn't be considering dropping it just because it had sunk to a little bit under double digits.
So we have documented the decisions that we make on a month-to-month basis. In this case, we sprinkled a little more in our Delex. I know that makes your skin crawl, Ken, but it was the smallest position, and the numbers are still pretty good except for that quality number. And it has been kind of cold lately. It's dropped down a bit, so that basically says maybe throw a little more at it. And then we also added a tiny bit to Green Brick Partners. And again, if you do your own study of Green Brick Partners, you will end up probably in a 10, 12, 13% range on the growth forecast. And I would warn you that many of the rhinos, the institutional analysts that are out there, are very pessimistic about the home builders, and I don't see it. Matt has done a lot of work documenting the demand and market tendencies going on in the home building industry, and he's having a hard time being pessimistic. Is that still the case, Matt?
I believe it is my second largest position, if that
There you go.
says something.
Okay, with real money.
With real money, yeah.
More than dollars.
If I'm wrong, I have to go back to work. If I'm really, really wrong,
Okay.
that's motivation.
There you go.
Mark, while we're talking about this dashboard diagnostics, the spreadsheet that you just showed, is that spreadsheet itself available on the Manifest site somewhere where somebody could download the spreadsheet itself?
It's a great question. As we go through this next, we're actually in the middle of, I forget what the techies call it, Kurt. We're doing we're bumping up the version. We're versioning the site. So we're basically refreshing manifest investing. One of the things we'll be taking a hard look at is making this available as a drill down screen from a traditional dashboard. So in other words, starting here and then drilling down into it, where you have an opportunity to track these key characteristics. Because Ken and I both believe, correct me if I'm wrong, Ken, that these are some of the major considerations for thinking through a prudent sale and management of the portfolio.
Absolutely, and to be honest, I don't think that there's any problem if you're thinking right now sitting there that 10 stocks might be a little bit something that you would not put a major portfolio together with only 10 stocks, and I don't think Mark is committed to keeping 10 in this portfolio. If one or two other companies should come to mind, I don't see any reason why the portfolio couldn't expand to 11 or 12 or even 13 stocks. I think the point we're trying to make is that it's not going to expand to 35 or 40 and still perform the way that's performing right now.
No, what would happen if Google went to $400 tomorrow morning? What would probably happen is we would sell it and it would become 2 positions. So that would make 11 companies at that point.
Yeah, and we're not so much worried about the physical sales of these companies and trying to maintain any kind of a percentage balance between small and large. Rather, we're trying to maintain balance between the overall sales growth in the portfolio. And that's something that we think that the people that were responsible for dreaming up investment clubs, we think they'd be very comfortable with, because that was the goal of this whole small large debate in the first place. It was to get companies growing at faster rates to kind of complement the companies that were growing at slightly slower rates.
We're going to have a slide on this in a few minutes, but the Novo Nordisk position there, along with Eli Lilly, will be talked about at a GLP-1 conference tomorrow. We'll have a slide on that here in a few minutes. All right, so switching gears, here's the best small companies for the current list, which expires on Halloween in less than a month. And Ken doesn't allow me to talk about this too much, other than to say that we're looking pretty good right now.
I really hope that since last October, some of you have invested in a few of these companies, because there's some great companies, great small companies on this list. And even some of those with red relative returns have, I think, wonderful stories and wonderful futures ahead of them. So I would not I would not like to be without at least 2 or 3 of the companies on this list in my portfolio. And if I count all the club portfolios that I have a little tiny piece of, I probably own 7 or 8 on the list, not personally, but I probably have exposure to 7 or 8 of them on this list.
Yeah, one of the things I think we'll talk about is this notion of persistence of growth. If you look, close one eye and look at this list carefully, the weaker performers are those that have downshifted, because they weren't put on this list with a single-digit growth rate. So all of these single digits that you see here, that has, call it a downshift, is maybe the way to think of it. And the ones that have downshifted are more likely to end up down here. And so maybe we come up with some type of a notion of persistence also, Ken.
Well, and then we got to keep reminding ourselves that 1-year contests are a lot of fun, and there are a lot of nice things come out of them, a lot of good ideas and everything, but we're not in it for a single year. I'm specifically looking right now at Technoglass, Mark, and I'm reminding myself that this has not been as good a year for Technoglass as the last 3 years have been, and Technoglass, to my mind at least, is still an extremely interesting, and to my mind, it's a pretty decent investment to have in my portfolio, even though this year it's not been treated as kindly as it had been in the past.
Yeah, and you want to be careful being too bruised, and the contusions you get from some of these, year-over-year performance. We'll talk about this during the program on November 1st when we make the selections for the next year. There have been a couple times when we wouldn't touch a company because it had hurt our feelings too much for a couple of years.
That's a great way to put it. Yeah.
Yeah, and then it leads the pack the next year. So you gotta, this is a long-term thing that we're doing here. All right, speaking of long-term, here's some of the places we have been. We covered Dataroma last week. We are waiting for a couple of the best small company lists to come out. Kevin's gonna join us to go over the Hoover's Handbook here in a couple weeks for a special nighttime edition of Bull Sessions. But again, we kind of turn over all the rocks looking for opportunity. And we're going to take a look at the Better Investing screen here today. Here are the current candidates. They are sorted by their projected return on value, which should resemble their Section 5 projected annual return. You can see that they do. And this is just a reminder that if you discover a small company, it better have a double-digit growth forecast, preferably in the 12 to 20% range, and it should have a return forecast. What it appears to be, it's going to need to be. I think it's going to need to be 12% or more to beat out the others. And that number probably goes up as we continue to delve for more opportunities.
I agree, and Mark, I also agree because I really do believe in manifest quality rankings, and I also think that we have room for a few companies with quality under 50, but maybe we don't have room for 5 or 6 of them in a portfolio of 20 or 25 stocks. So
absolutely,
I'll be looking very closely at the quality rating on some of these companies on this list as well.
And the size is not out of control in terms of annual sales either. Every once in a while, we get one that tries to sneak in with several more $1 billion than we would like, but that doesn't seem to be happening here. All right, Ken, go ahead and talk about one of your favorite screens here.
I love this screen. This is from the SSG Plus, from Better Investing's SSG Plus, and it's a one-click screen, and I run it maybe twice a month, even 3 times a month sometimes. And you become very familiar with some of the companies on the list because they make the screen time after time after time. But there's always new companies on this list, and this is a great source of ideas. Right now, for example, I think there's 3 very interesting companies on the list. Oddity Tech, UFP Technologies, and US Lime and Minerals, United States Lime and Minerals. I think those are very, very interesting. I've always been interested in the Descartes Systems software company, but find it a little bit difficult to invest in because it's a Canadian company, and it's a little bit more volatile than a lot of the smaller companies that I take a look at.
It does have an ADR also, though, Ken. So
there is an ADR. You're absolutely right. And then I just want to point out that Propel is another interesting financial fintech company, if you will, but it also is a Canadian company. Look at that sales growth for that company. And so you want to just be a little bit more careful when you're moving into these small companies that aren't domiciled here in the U.S. Canada used to be, us Michiganders used to think that we were a quarter Canadian, and I still kind of think that we're at least a quarter Canadian, if not more. And I'm sorry to see that the relationships are not as cordial as they have been in the past, but I'm hoping that's a passing thing, not a permanent kind of a thing. But there's this list. And this list never has more than 16 or 17 companies on it. You can see that it's very short when Mark captured it this particular time. What's that? Maybe 10 or 11 maybe on the list right now. And
a couple repeats.
Yeah, so So I just think it's worth your while to just go to that predefined screen, do one click, and just look at it every couple of weeks to see what's new. There sometimes nothing, and sometimes 3 or 4.
And Kim, is that
Have you ever heard of Caro before, Mark, or Carew? I guess they want to pronounce it.
I have, only because I was curious about the name, so I have looked that one up.
Yeah.
And
Yeah.
I was curious about this bank. Is this one of the banks you asked for us to add to coverage?
I asked this one to be added to coverage only because it has a very robust return on average assets number, up higher than almost any other bank I've ever looked at before.
All right.
So I did
We'll
ask that be added to coverage. I think it's something that we really want to take a serious look at. It's quite small, quite small. But with that in mind, when you have a return on average assets number like that, you might want to see what you can think about. Laura is telling us that USLM was a feature in the special situations, a feature in the small and mid caps, and that's from Value Line right there. And she's absolutely right. Look at these companies that do some of this lime production, and there's a number of them. Look at them in the context of being mini monopolies in their geographic areas because of transportation regulations about moving this stuff along highways in big trucks. It's an idea that I don't think many of us have even considered. But US Lime makes a big point about how they're a really big player in the geography that they do most of their mining in, because there's so much regulation in getting this stuff from the mine to where they process it. So consider that as you're looking at companies like US Lime and Minerals.
Yeah, we'll take a closer look at that. All right. Here's a quick reminder that 2 weeks from today, we will be taking a look at the Hoover's Handbook of Emerging Companies. And Kevin actually did an exercise last year. We're going to ask him to somewhat revisit that. This will be a special nighttime edition 2 weeks from today. And Kevin will join us for that, taking a closer look into the book. The point we like to make is that if you go and buy a recent copy of this book from Amazon or one of the online book services, you can actually end up paying over $1,000. A year old, it's at $125. But if you go back a couple years, you can actually end up with a $2 or $3 or $4 purchase. Here's your reminder of what we're looking for: ideas. And this is straight out of this year's book, and you can see that there are a whole bunch of companies mentioned. And we'll be going through most of them, and we're just going to start with the A's, Ken, and go wild.
Mark, a logical question is, what time 2 weeks from now?
I don't know. What did we decide?
I think I have on my calendar 7 o'clock
Let's
p.m.
Let's do 7 p.m. Eastern time.
Sounds good to me. All right.
All right. So that gives you just, keep in mind, that's just the A's, B's, and C's, and it's a partial list at that. Here's what they look like on Amazon, so you can actually go back and buy some of those older ones for a couple bucks. You don't want to go too far back, but this is the one from the cover from 1995, Ken, where I discovered Cisco Systems in our Chicago Investment Club. I think that's the book right there. So Kevin has provided a link to the PDF. If you're a Manifest Investing subscriber, it's in the forum, and you can find it at this post, so you can actually dig in and look at the entire book for free. So again, if you're a Manifest subscriber, you can get to it in the forum and come along for the ride here. You can see that Kevin has provided a copy of the book.
I have another logical question, Mark. On the 21st, will there be 2 bull sessions? I think the answer is no. There'll be 1 bull session, but instead of at 2 in the afternoon, it'll be at 7 in the evening. Am I right?
Yeah, we'll start at 7, and then we might go for 6 hours. Kidding, just kidding.
I won't make it that late.
He's just kidding, folks. Just kidding.
Oh, I do want to mention that to anybody who's looking for a library. In another discussion group I was with, someone mentioned that the Las Vegas library is free to join, and it has Value Line and Morningstar both.
Cool. Good stuff. And they probably have a copy of this book available too, perhaps by PDF. Who knows? All right. So with that, we'll leave with just this is a current update. You can see that the companies that we mentioned, US Lime and Oddity and Ken, what was the other? UFP. They're in pretty good standing on the list of candidates so far. Okay. So with that, just a reminder that we will be taking a look at this book sometime in the next few weeks. David Gardner's book is Magnum Opus on investing in what he terms rule breaker investments. And I did recently listen to a 1-hour summary that he put out, and I'll probably put that in our forum. And it's just a refreshing reminder about what can happen if you hit a few home runs with some of these rule breakers. You can see the names down at the bottom.
Really interesting, Mark. I went to my local Barnes & Noble to buy the book, and they had no more physical copies left. I had to place an order for it.
Whoa.
So it evidently is selling fairly well.
Good for David. Good stuff. All right. Here's that webcast that I had mentioned coming to you courtesy of the First Word. It's an industry site on pharmaceutical development, biotechnology development, and it's tomorrow. I want to check in. I don't know, maybe we'll do a simulcast or something along with it. Who knows? But definitely a pressing subject when it comes to Novo or Eli Lilly or some of the other companies which may be discussed by these experts in the industry when it comes to GLP-1. All right, we do archive all of the presentations we make, whether they're bull sessions or roundtables. You can actually go back and retrieve these by going to YouTube and just simply searching for Manifest Investing or Roundtable. You'll find them. If you can't find it, just let Ken or me know.
Yeah, Mark, stay on that slide for just a moment. Constantly we get comments about they can't find the Manifest Investing channel. That's because it's not the Manifest Investing channel, it's Manifest Invest. And I don't know why it's truncated, but it is, and that is a correct URL up at the top of the screen right there.
You can search for it though with the separation in the words, and
you can search for it, right? Right. Yeah.
But they truncate things and they just keep things confusing. I blame it on Google. All right, and since Ken was high-fiving over recent success with, was it AMD had some good news? That's Ken's investment club.
I've taken a lot of shots in the last 3 or 4 years about my my original choice of AMD, advanced micro devices. Yeah. I've taken a lot of shots about really being very much in favor of Lisa Su and her management style and the fact that she sets goals and then achieves those goals. And most recently, she has shown that there's a lot of people that have some confidence in one of their new chips, AMD's new chips. And if you're lucky enough to be a stockholder in AMD, you saw about a 25% increase yesterday in the stock price. And this morning, at least, I haven't looked recently, but this morning it opened up another 10% higher based on a huge deal with OpenAI. So my love affair with Lisa Su continues, and the wolves are howling at the moon, and we're happy about that investment that we made quite a while ago in this stock.
Yeah, and this is from when they won the groundhog contest, probably what, 15 years ago.
It's been a while. So.
Good stuff. And for those of you that aren't familiar with Lisa, Lisa is Jensen Huang's brother or sister, excuse me. The guy that runs NVIDIA. So I would pay to be at their Thanksgiving table. Listen to the two of them. You got NVIDIA and AMD sitting at the Thanksgiving table.
Marie is correcting you, Mark. I think they're first cousins, but it's close.
Okay. Close enough. Close enough.
Yeah.
It'll be a great Thanksgiving table. All right. Good to go. Anything else show up? So we will continue our hunt for best small companies as we round out October.
Well, you haven't done this in a while, Mark. You're right smack dab at 3 o'clock today. Okay.
I'm licking my finger and marking the air. All right.
right.
Well, good luck and thanks everybody. Keep the ideas coming, and at least now we've told you what you need to achieve with the nominations, and get out there and find those nuggets. Thanks, Ken, and happy zip lining.
Thank you. Bye-bye, everybody.